Who's going to be running Bellevue in FY27? That's a good one.
Is it cheating if I say the same? Do I have to go different?
Righto, buddy miners. I figured out 5-day conference. Takes 5 days to get the voice back. I'm in day 4 of voice recovery.
Day 4.
What a bloody week.
Sounds like your voice is about 70%.
70%. I'm nearly there. One more day.
Nice.
Bloody don't mind I had a haircut and a different hat, so I think my face looks chubbier. But anyway.
Going for a new look, Matty.
Thanks, AusIMM, for a bloody great week. And
Sounds
the
like a
Resource
ripper.
Rising Stars. Good times. Boys.
Sounded wicked.
Matty.
Bellevue, the news has come out today, so that is probably going to take up the whole show.
I think we may as well just talk about it. It feels like they kept everyone in suspense for a while while being in voluntary suspension, and we finally get news today that there's an equity raise to go with it.
Yes, one of the best sealed suspensions going around. Most of them are like that, but it was it didn't like there was a lot of speculation,
but no like very rigid rumours during that period. I think.
I would say my prediction last week was based on nothing. I wouldn't have been surprised if they didn't come out of suspension at all, and it was just going to be a sale. I was sort of surprised it got to this stage.
That'd be brave, yeah.
Yeah, so because I assume there probably would have been a bit of interest during the suspension, which we'll go into, which was mentioned. So yeah, a lot to cover. So let's take it away.
I guess first and foremost, guidance. First thing, right? So FY25 redone at 129 to 134 at a midpoint of just under 2,500 Aussie, all in sustaining. So kind of like we touched on, Matty, that puts it at kind of 40 to 45,000 ounces needed for the final quarter of the financial year.
Yeah.
And then obviously you've got the 5-year plan being wiped, 150,000 ounces marked for next financial year, and then a kind of 3-year period where they do 190,000 ounces. So that's a kind of basic 5-year-ish plan, right?
Yeah, so essentially it looks like for the moment the whole 200,000 ounce number has been wiped. Like doing the calcs for 190,000 ounces, that's saying at about 1.2 million tonne per annum at the reserve grade of 5 grams a tonne. They did say on the call they were talking about 1.35, but then they were saying the reserve wasn't going to be changed. Like one thing is probably surprising that the reserve grade wasn't dropped. But these were like not guidance numbers, that 190. There's like a indicative prediction for FY26. So yeah, it was.
It's a fair way off where they'd last signal when they raised money, right? Like they'd raised their last equity and sort of talked about a 250,000 ounce per annum kind of.
Yeah.
Ambition.
So they're probably the numbers that aren't sort of adding up, saying 1.6 million tonne was going to get them 250,000 ounces, but now they're indicating maybe 1.2, 1.3 is going to get them 190,000 ounces. So, which makes me think can't see it being it potentially just might not be a 5 gram mine, it might be a 4.5, but they haven't yet said they're downgrading the reserve.
Yeah, exactly to that point, Matty. There was the question kind of asked, and they were kind of prying into that sort of 60,000 ounce per annum reduction that we're seeing. Is that purely a result of, instead of doing 1.6 million tonne per annum, doing 1.35? Or have you worked in a bit of buffer by being a bit conservative in your reserve? And the signalling from management was that it's mainly a factor of just that throughput number coming down and not actually conservatism in the reserve grade, which we've of course sort of seen kind of trimmed last year or so. So I think you're on the right track there. I was kind of expecting that a bit as well when you see that they're going a bit more cautiously at the overall output of the mine.
Yeah, and you look at the photos here, like in terms of trying to figure out what the reserve grade is from a geological estimation point of view, and you look at this top picture here, you see a lot of like bits of this is just in the drive itself. Who knows what's in between the levels and everything, but like you see bits of internal waste there, like in a couple of spots, like you see in one picture down the bottom, it's like pretty wide in the drive, and then you see it pinch up at the top. So I think there's a lot of pinching, swelling, bit of internal waste here and there. So trying to wrap a accurate number around the reserve is probably a bit challenging. Whether, I don't know if 5 grams is what they consider conservative or not, but maybe there's a lot of factors that contribute to. They talked about in the blind stopes that I'll say they were talking about 3 blind stopes they took at the end of quarter, how like the fault cut it off at a point, so they took a lot of waste. So by the sounds, there's a lot of cross-cutting, like faults that can shift the ore around. Like that's on the extremities. Look, I'm not sure. I think there might be also faults within the drives that can sort of jump it around a bit, and you can follow it in the drive, but there might be a fault up in the middle of the stope that you don't know is there until you mine it and the grade's lower. So
Gotcha.
like there's a lot of, it sounds like they do point to geological complexities, I think they worded it, or for parts of the quarter. So I think that's probably going to be a thing going forward.
You could kind of infer the degree of confidence or lack thereof when they talked about. I think they said the June quarter mine plan is 90% delineated with grade control, and they said the next 2 quarters, so I think September and December quarters, are 75% delineated with grade control. So yeah, there's confidence to be had through all of that, but no reserve downgrade yet.
Yeah,
just a change in guidance and.
I think they'll get it by tonnes.
Yeah.
Like it looks like with the upgrades they've done at the mill, they've shown that they can get 1.35 million tonne through on an annualised rate. So I think if you do the maths, 1.3 million tonne at 4.5 grams is 190,000 ounces, whereas I think it's 1.187 at 5 grams is 190,000 ounces. So I think they've got the capacity to get the tonnes through extra to compensate if there is a bit lower grade than expected, but who will own it? That's the other thing. But 190,000 ounces at 2,500 all-in sustaining cost, you bloody take it any day of the week in this pricing environment. So it is dressed up as something that will be appealing, but we'll get to that.
100%.
What about the raise, JD?
Yeah, let's talk about the raise before we jump the gun and get into who's going to be the owner of the mine in due course, or have a brainstorm about how that plays out. But $156 at 85 cents is the raise. So 26% discount to the last close, or 30% discount to the 5-day VWAP before they went into halt. Just chatting with people and hearing rumours and stuff, some rumours were that it would be at a bit of a steeper discount. I mean, it is what it is at the end of the day. It's a fair lick of money after they raised not all that long ago. In terms of the use of funds, about 110 million is going towards closing out hedges, which we'll speak to as well, and 40 million just going in the bank for working capital. That kind of leaves them with about 90 million bucks to see them through over the next few quarters. And then, of course, that $100 million in debt that they've got, which is payable in sort of 4 lots over the calendar year 27 period.
Yeah, because you would have thought with that suspension it was going to be 75, like 30+% discount. Like that was the sort of the thoughts, which indicates there's, to get a 26% discount after being in suspension that long is like some fund or something has probably come in pretty big and set that price, I would assume.
What do you reckon the raise price would have been if they didn't allude to a strategic review and corporate bids? That's an interesting question, right? If they didn't say that, I reckon that raise would have been
that's the carrot.
Maybe even 10 cents lower. Like who knows? It's.
I think whether they raised or not, it would have opened at exactly the same price.
It was actually trading. They got an OTC listing, which you couldn't hold that. So that thing was trading at 50 US cents, I think, last saw. So I don't know how much liquidity there is on that, but that's to some degree a bit of a price barometer amidst all of everything that's going on.
Yeah, and it looks like the March the March quarter was obviously the catalyst to this whole event. 25,000 ounces at all-in sustaining costs of 31.25. Like they've talked about, you see in the comments, talking about localised geological complexity, some suboptimal mining practices, which indicate, and it's what we've said all along. I think there's always been a bit from column A, a bit from column B, a bit from column C. So there's geological stuff, probably some dilution, or there's just been a bit of everything that bloody is causing them to fall short. So.
To your point, Matty, on the faults as well at Viago, specifically delaying access, they said, to a higher grade stope hits it, because I think the head grade came in at 3.1 grams per tonne, and obviously, there's a few factors playing into that one, but not being able to get into some higher grade spots is not advantageous, right? And as well as that, mate, the Viago decline was delayed, so that's sort of been pushed out a bit. And to kind of give the market and give investors a bit of confidence, I think they spoke to April's head grade coming in line with expectations, i.e. sort of better than what we've seen over the March period. As well as that, you've got the review of the resource model, which I think everyone's was pretty eager to sort of see, and they reiterate confidence. They kind of speak to how little of the near-term ounces are coming from inferred, and there's only so far out you can kind of do that before it gets cost prohibitive. But I think that's certainly things people wanted to see.
Yeah, and like the new mine plan they put out, we went over the physicals before, but look, they've pretty much, it's a bit of a scale back. They're going from 6 jumbos back down to 5. They're going to they're obviously wiping a lot of the capex to go out to these new areas. It says that the Viago mining area, I think they're delaying going out there, so they've put ground conditions as the cause of it. So that might be just passed on to someone else to go chuck a upgraded ground support regime in, because it's like they I think it's pretty good ground everywhere there with, the standard split sets of mesh. So it sounds like that area would probably need a bit extra. So that's probably a good thing to leave someone else to call Sandvik for a bloody some ground support products that
absolute layup,
might
Matty.
be used there, which I got to see at Underground Operators.
They would have been in shining colours.
Look at me standing with the $1 billion man here.
Oi.
Have a look at him.
Oi.
Derek.
Look at
The
that.
main man heard.
I'd say he looks $1 million, but he looks $1 billion.
He is a bloody $1 billion. Did I say million before? He's
No,
the
you
$1 billion
said
man.
billion, yeah.
That's what they're calling him. And so, mate, should have seen on Showcase. This could be good for the Viago, actually. It's a self-drilling posi mix bolt with a hollow centre with and there's new resin injection technology that they're going to bloody bolt onto the Sandvik jumbos, squirt it up the hole, encapsulate around the posi mix bolt, and absolutely revolutionise the installation of posi mix bolts, all because of the $1 billion man.
Unbelievable, mate.
Good move, Sandvik. There's bloody that. There was bloody, mate, resin injection was the feel of the conference.
That is interesting. I'm glad.
Bugger all about green energy, I can tell you that much. that wasn't even to be seen at the conference. She's all about resin injection. So, mate, good to see the $1 billion man. So
Go Sandvik.
Go Sandvik Ground Support.
So what else, JD? You got some other? Go through the update.
We can just we'll just fly through the rest of the mine plan update, right? Because I think it's kind of important in how the narratives kind of changed, because when they came out last year with the capital raise, we all kind of knew it was to address underlying issues, but they kind of had to wrap this big growth narrative around it, and obviously they've backtracked on a few of those. So they've kind of spoken to reducing reliance on the Marceline mining area, a bit of a reduction in the Deakin Main average ounce delivery. Also, as well as Viago, delayed access to Deakin North, so that's been pushed out by 6 months. And then, Matty, you'll speak to this point a bit better, but they speak about increasing in the lower mine pillar sizes by 60%. So from memory, below the 550 sort of level, they're changing how they're going about things down there.
Yeah, it sounds like I didn't read enough on that, but I assume they're either making the pillars bigger or putting more pillars in and reducing the strike length of the stopes. Like they're obviously identifying as they go to depth, they might have some increased stress and they need more pillars left between the stopes. So I'm not sure if they're just making the pillars bigger or they're putting more pillars in, which is essentially 60% more pillars being left in the ground. So, yeah.
Yeah, and to wrap cost numbers around it, they speak to $35 to $42 million per month being the all-in, corporate exploration, the all-encompassing cost base that they're going to experience through FY26 and FY27. So doing a bit of bush maths on those numbers. If you take
I love some bush maths, JD.
I did it just for you, mate. So if you take the midpoint and annualize those numbers over FY26, where we're talking about 150,000 ounces of output, you're talking about unit costs of a bit over 3,000 Aussie an ounce. Now, remember, not all in sustaining costs. This is kind of everything or most of everything in it. Now, if my numbers are right, hopefully they are, that's a cash flow of a bit over $300 million Aussie in FY26. Back of the envelope, after they pay out the hedges like they've said, there is a $110 million liability that still needs to be paid over FY26. So just net that off against the cash flow and you're getting about 200 million-ish in free cash over that period. Again, might be a bit of interest and other things they need to pay on the fringes there. Over FY27, when they move up to that 190,000 ounce per annum profile, the unit costs pull down because the total costs are the same, just using that midpoint again. And you get a unit cost of a bit under 2,500 Aussie an ounce. So at these gold prices, super healthy margin. That's $2,700 an ounce, or cash flow of a bit over 500 million. Again, of course, big hedge liability, 130 million over that period. That's the kind of delta at the moment we're seeing there. And as well as that, you'll have 50 million bucks that needs to be paid in the first half of calendar year 27 in debt. So that leaves about 330 million bucks for the owners. So not too bad. And I think that's going to tie in well with our conversation on who wants to own this or who might be interested, especially when it comes to tomorrow and we see where the thing starts trading at. But that gets you a bit of a ballpark for a company that if they come out at 85 cents, it's a market cap of around about $1.25 billion. So, it'll be, I think it'll be enticing for some people, but I think we'll talk through a few more different aspects before we get to that point.
Yeah, I think the interesting thing about that, we were just talking about it before, is once it'd be interesting to see now that they've slowed down a bit, they're going to, as you said, focus on quality a bit more, like the really focus on the ore extraction and the de-risking and risk profiling each area to make sure it's drilled. They know where the faults are and everything. It's like whether they're going to be always struggling to hit guidance, it's always going to be a push, or there's some potential upside where they can freaking have a 60,000, like a high grade month and a 60,000 ounce month. Like it's yet to be seen if there is that potential outperformance in the ore body or not once they really hone in on everything, or it's going to be one that it's just going to really struggle to hit, 45,000 ounces each quarter when they get to that point. Who will know? But it sounds like when they were talking about delaying, was it delaying the Deakin North, I think? So it sounds like they were, which obviously means, right, we could go there now because I assume that's one of the bloody Deakin's, the high grade area, or we can delay it, save the capex, and then make 27, 28, 29 a much smoother period. So it's good. It just, I think this, and to be honest, I think this is what everyone wanted. They just wanted a realistic something that they're like, that sounds achievable. It's not over ambitious. It's not like we're like a bit of belief that we're like 180, 190,000 ounces. Yeah, we feel that could be achieved, and not at $1,500 all in sustaining. So yeah, it's this is what I think the big dogs have been wanting for a while.
Yeah, for sure. And you go, Trav.
Yeah, but it's kind of symptomatic of like expectations have been set too large for what's doable here, and that's kind of why that Bellevue's been like a big underperformer amidst every other kind of gold name, just really, benefiting from this gold price environment. Yeah, it's you don't want expectations to be beyond what's achievable, because then you actually want to be able to outperform market expectations consistently, and that's how you become a market darling. That's how the market loves you. But this, unfortunately, Bellevue was a market darling before it could prove itself, because the expectations were so big. So it's unfortunate, but hopefully that recalibrating of expectations of what's actually like doable, and then constantly setting them realistic and then over delivering will help it navigate the next period ahead.
As well as like market expectations, Macquarie has to have their expectations sort of re-gauged, right? Because you've got these covenants and all these other sort of bits and pieces that are based around the original My Plan. So Macquarie sort of said that they've waived their review event kind of rights. And this was triggered by the quarterly production test at the back end of the March quarter. In simple terms, the output over the March period is just not close enough to the mine plan, I would guess. I mean, there's a few other ways of assessing them, but Macquarie, the lender, they want to be safe. They want to reassess their risk, and they have rights when these things are sort of breached. So you need to go and present the new mine plan to them, get their permission, and with their permission as well, close out the hedges. And of course, for all of this stuff, they're going to get paid as well, right? Sort of in the fine print, they're getting 8.5 million shares just to restructure and for the privilege of paying out the hedges.
For zero cash, 8.5 million shares. You had to squint your eyes at the footnotes on page 12 to read that. But that's $7.3 million at 85 cents a share. That's an enormous fee in the banking world for a kind of a restructure of hedge obligations.
Yeah, I think there is a bit of a cost associated with doing it, plus I assume a margin on top for that privilege.
Absolutely.
It's a giant fee.
Yeah, I mean, let's talk more about the hedge book. Trav, I know you jumped into it. Maybe pull up your notes on that one.
I did have had a look at it. I mean, you can see part of that restructure involved rolling some hedges beyond the previous latest date of that hedge period. So, March quarter of 2028 now has some hedged ounces, which it didn't before. And while rolling of those hedges alleviates near-term kind of cash flow, and you can maximise your free cash flow in the near term, it does kick the can down the road to an extent, right? And it has to be addressed at a later date and for a longer period of time than you previously envisioned. And unfortunately, there are examples and precedents in gold miners in our state where if you roll hedges and you kick the can down the road, that liability can grow substantially more in value if the gold price kind of goes much higher than you thought, and all of a sudden, you thought you kicked the can down the road, but it was at a reasonable gold price. All of a sudden, it can look pretty daunting as depending on what that gold backdrop looks like. And I just think that's worth considering the implications of all of that. Despite the Macquarie fee there, I was kind of interested in plugging in the hedge book into an Excel workbook and just having a bit of a play with it. And if you just chuck in, spot price right now of 5,200 Aussie for a gold price, then what they're actually, the value of out of the money value of the hedge book that they're actually going to close out is only about, it's like less than 30% of what the total hedge liability would be if they didn't close that amount out. So this raise is like 15% dilution to the equity capital structure, and you're making it's a modest dent in the overall picture of that hedge liability, which is subject to getting bigger if gold price goes higher as well. There's still about 350 Aussie dollars at 5,200 gold price right now that would still be there in hedges, which can and there's a period there. I think it's the back end of 2027 where the quantity of hedged ounces kind of shoots quite a bit higher. So just managing that with your mine plan and all that sort of stuff is going to be interesting. I think they alleviate the near-term stress with this, which is good. They can have some near-term good cash flow, but I don't think investors should ignore what remains at the end of it, which is still a substantial hedge book.
Yeah, because you see those two you're speaking of, it looks like if they have a 45,000 ounce month or even below, like that's half their production is hedged at. What's that, 2,900?
Yeah, 2,906. Yeah.
Yeah. So, and as you said, right, when the principal starts being repaid for the debt as well.
Exactly.
So,
Yeah, there's that 100 million I think is payable CY27. So you've got a bit of extra cash flow pressure that comes in calendar year 27. Of course, that's not today, but it is sooner than we all think. So yeah.
No, probably the thing that'll help with in the shorter term for delivery of these ounces, and probably 27 as well. This is like a back end problem. Is like. Because it sounds like that paste plant isn't happening anymore. Because I was talking about.
Isn't it?
Nah, I've searched paste, can't find anything. So it sounds like it's just going to be a pillar operation.
Wow.
So that will speed up the mining rates because you're not relying on paste or everything, but you're affected. And it was in the study. I think in the study was calculated, 82% recovery of the ore, which takes into account the pillars that are being left. But they're obviously looking at putting a paste plant in to get 100% extraction or close to 100% extraction of the ore without which elongates the life of the asset. So bad news for Quattro because that's probably looking like one paste plant that is not being built, but someone else's problem is someone else's opportunity.
Someone else might
that
have
is
to call
just
it Quattro.
like that means you can get them working on your paste plant when they would have been working on this one.
The paste systems
Somebody
that
will
go
be
underground.
over the moon out there.
Oh, look at how excited you two are.
I'm excited. Just thinking about
just
it.
going at it. Mate, you would have been excited if you'd come and seen the QD too.
What's that?
Underground operators.
QD.
Mate, have a look at it. The Quattro Diverter version 3.0.
Unbelievable.
Mate, this thing, I had lunch next to it each day that I was at the conference at lunch. Might have flipped on the night shift from bloody Wednesday onwards. But, mate, these diverter valves, they've just got even better. 50% increase in the pressure rating, like 15 MPa pressure rating right now on these things. Bloody, mate, manless hanging system to put these things up. So manless. Like you're just, same as the fan hanging system that they've got. Like just chuck it up there, keep everyone safe. Mate, the automation that goes in with these QD2s. So if there's a bloody pressure rise detected in the retic line, the system will automatically flick it over to the dump line, which will drop it in a sump, protect your retic, and you don't block the whole line, all because of Jeremy Palmer.
That is amazing pace system innovation.
So if you want to protect your retic line, go buy a shitload of QD2s or QD4s with the increased pressure rating and just keep your retic line safe. It's just a beautiful piece of engineering by Quattro.
Go Quattro.
And thanks for the lunch table.
It'll pay for itself. Go Quattro.
Mate. Anyway, now the strategic review. Sometimes you want to hear it. A lot of times you don't want to hear it.
Yeah, it's usually kind of the death knell, right?
I reckon you want to hear it here.
Yeah, when a company with multiple assets says strategic review, it's not normally a great sign, but there's a bit of nuance to it in this case. So they flag looking at internal and external options, and then they sort of mention control changes. So a direct snippet was that Bellevue's confirmed it has recently received unsolicited approaches relating to a potential control transaction. So they say no formal proposals or offers were received, of course. That's not a big surprise, but people are having a bit of a peek. They're looking around, they're seeing what they can sort of do with management, where they can kind of get to. And it was interesting to hear the question asked, like how many of these, if you can put a number to it, or if any of them came in the last 2 weeks.
Can I
This
play
was
that
a question
snippet?
on the call.
I'll play it.
Let's play it.
But before you
do
do, you should have seen how many unsolicited approaches I've seen between mining companies late at night at underground operators. Mate, so good. Oh, what a place to be. Right in the heart of it.
Where business gets done, eh, Matty?
Alrighty.
Just on the question was asked previously, and I won't draw you on more detail around the approaches from third parties, other than to ask about timing, when they might have been. And the question for that is, I'm curious to know whether a third party has approached you in the last 2 weeks, in opportunistically in what's potentially a position of weakness, or whether there have potentially been approaches prior to this, the last couple of weeks of uncertainty. Yeah, look, I think we've said what we wanted to say in the statement that's in the announcements, Paul. So I think we'll just decline to comment. It's no upside in discussing M&A and speculation on that front. So look, we've said what we want to say on it, and if there's room for a future update, we'll provide it to the market as appropriate.
God,
Interesting, right?
that's like the anti-magnetic response. What was he bloody?
Everyone's in the data room. Everyone's in it.
Was someone doing their washing up while they were answering that question?
No, it was because I was recording
right.
speaker into a microphone and tapping the desk. But
Not going to lie, I did have it on like 100, trying to I can put my ear to it to listen to it. But it's interesting because we all got kind of attracted to the same snippet. Really, really interesting to see.
I found it interesting because because like Strello responded by knocking back the question. But here's one view on the response to that question. If there was an inbound NBIO before the trading halt, for example, that's worth a bit more than after the trading halt, in my opinion. It's a letter that possibly is anchored to a price that's sort of much higher than the cap raise and higher than it was when it went into halt and all that sort of stuff. But if the interest has only come after the trading halt, it's not as promising. Lots of miners would be a bit opportunistic when you're in a 3-week suspension and you, of course, you ping out a letter. You don't know how dire it is, but you ask for access to a data room and give me DD, maybe I can give you a proposal and firm it up and all that sort of stuff. So I wouldn't be surprised to see a lot of people kind of opportunistic in that situation, but it's a different level of firmness and seriousness if it came before versus after. And if they came before the trading halt, then what would have prevented Darren Strello from just saying, no, we had some before? So maybe the inference you could have is they could have all come after.
Yeah. Yeah, and to my knowledge, I don't think any strategics are being let into this cap raise either to try and get a foot on it either, because competitive tension is their best friend at the moment.
Totally, and
for this,
and they're signalling to the market that they are exploring the options to maximise value. Right, they list 3 advisors that they've now got in their court to help them maximise value. So the inference is, at the right price, they would consider a corporate change of control. Just how real the interest is from third parties, I think, remains to be seen still. And I do wonder what price they would have had to raise at if they didn't reveal that they had corporate interest. But I'm very curious to know what you guys think of in terms of what the potential corporate interest is, who would be interested, do you think Bellevue will kind of get engulfed by a larger miner with a more thorough balance sheet to absorb some of the funding stuff?
Interesting what you say is will there be with the mark to mark on the hedge book and everything, will it be competitive or will it be a larger miner or will it be a smaller miner that might be able to take a swing of this, mate? Between
mid caps could,
between, and some of them aren't that small, like Catalyst, on the smaller end.
Wow. Mark, it'd be a
takeover. Huge. But that's the thing. If there's not heaps of interest, it might provide a opportunity for them. But then you got all the Regis they haven't got really the geographical synergies, but they're
if they're looking
printing
at
a bit of cash,
they're looking at Ravenswood, which has a lower production profile. It has a worse hedge book, a worse debt situation, and more operational kind of question marks over it, and Ravenswood wants $2 billion. Yeah, if you're Regis, you're thinking I could pay less than that and close out all the hedges and yada yada and have this thing. So I think if you were to look at the two options side by side, you go Bellevue, but so I wouldn't rule Regis out at all.
Nah, no. And before I go on the other ones, when you reference $2 billion, so after this, there's going to be 1.5 billion shares on issue. So that means if it got done at $1.30 would mean essentially $2 billion plus the hedge book and the debt out of the money. So it's about a $2.4 billion deal, equivalent to Spartan for a walk-up start to potentially 190,000 ounces or 150 to 190,000 ounces for a 3 million ounce resource. So that's the price. Could it get done at $1.10, which would be a bit below the about $2 billion once you clear everything out. So that's the sort of share prices you're looking at for what, potentially a deal could be done, depending on where it trades on open tomorrow. But we've went through the previous ones as well. Like Goldfields could flick it over to Agnew. I think.
Goldfields.
I think it's only a 1.1 million ton mill. I'm not sure if it's expanded, but I assume that
it's bigger.
It must be bigger. The chat GPT let me down the other way. It must be bigger. Like the big ones are obviously Volt with. They're expanding to 6 million tonne, and they've just, I think, approved the $80 million expansion to put the ball mill in for that, because I think it's just one big sag at the moment. So that could take it, but they've obviously got their own hedge book to deal with. But you'd think they'd just clear this out anyway, or they might just keep it there. They love keeping cash. Thunderbox, Northern Star, that's a very logical one.
Big time.
And the De Grey deal's about to be signed off on anyway. My understanding
is imminent.
Yeah, and I did have a look through that, and it looked like Northern Star could do anything. It was De Grey that couldn't do a deal.
There was a materiality threshold, and it was basically, I think the threshold was like anything more than $1 billion would be like deemed too material to do another deal.
But could De Grey approve it? But
it wasn't even a consent thing. It got messy. on that front.
Yeah, right.
Yeah.
I did some control effing.
Yeah, but it's kind of irrelevant because the deal's going to complete soon anyway.
Right.
I do think that it's hard to pay more than the companies that have synergies. So the synergies are Goldfields and Northern Star, and you might think synergies is weird.
And Volt, I reckon Volt.
Sure.
Big time.
Yeah. Less balance sheet to maybe splurge with, but certainly synergies. And then because the synergies exist because you've got high grade stuff that your processing costs are much lower than putting it through the 1.2 or whatever million tonne per annum plant that Bellevue has. If you're sending it to your much larger economies of scale mill that you've got 50, 60 k's down the road.
Yeah, and they could probably bloody with other stuff in the region. They could turn that into a toll treating mill up there.
You could sell it to someone, sure. Yeah.
If Vivian comes back online ever, there's plenty of options. But yeah, they're the
What do you think about Genesis?
I don't think Genesis. Geez, you never know. But considering what they paid $140 million for Dacian to set that whole area up, doesn't strike me as a company that'll be paying $2 billion for something like this. I think their counter-cyclical investing is complete. Evos, are they in harvest mode? I'm pretty sure. I don't think
they will.
I don't think they'd go
this
at
is
it.
Not their MO, is it?
No. Nah. Yeah. So, for Northern Star, they'd probably be able to get it all script.
They could. They probably could.
I think that if they were to do it, I think it'd be script, right?
Yeah.
Similar to what they did with De Grey.
And it's a pretty safe bet to take their script, you'd think. Liquid, very liquid.
There's certain people that'll be, still at these prices having a bit of a win. So cash might lead to a tax liability. You can potentially get rolled if you're still bullish the broader gold narrative. Rollover relief if it's script. I mean, on the margins that ties into it.
Yeah, I think that's pretty much everyone.
I think lower than 130.
Yeah, I agree with you on Genesis.
Yeah.
By the way,
I think if a deal happens, I think it's going to be lower than 130. That's my just gut intuition on sort of how. Yeah, I do think there are definitely some I use the word desperate mid caps who need to do a deal and are hungry and yada yada yada, and there's a very realistic chance that something happens with the cohort, but the price matters. How much you pay does matter, and even though we anchor to the share price, or the share price has come down so much, so a deal must be more attractive. There's a bunch of dilution, and you still got to pay more shares to. Yeah. So the quantum you're paying can still be quite onerous, even though the share price looks lower. So companies are constantly thinking about what the total amount they're paying is here, and even though the share price has come lower, it's still big. It's a big price tag. You want to be very confident that the cash flow is going to come from that investment.
And would Macquarie have because Macquarie are holding obviously the debt, but the bigger quantum is the amount, the out of the money hedge book liability. Would they have a say at all on offers? Because it might be in their best interest that a $1.10 deal gets done to take away the risk from them to potentially not getting that gold in the future is a risk to them.
They wouldn't have a say on offers. They do, like any deal, it'd be subject to, certain consents per whatever contracts you have in place. For a project finance. It depends what the buyer wants to do. Do they want to clean out the hedge book on the acquisition, or are they keeping it in place? Either one does need a certain consent, but it's assigning rights to a larger, better miner or something. Macquarie would say yes to every day of the week, and they're not. Yeah. And
it looks like they're obviously they've signalled that they are very amenable to selling it. I think that's pretty clear cut,
which is positive if true,
and good for Macquarie. What about the and it was a good question on the investor call, and it was probably the thoughts are, why have they cleared the hedge book? Cleared 100 odd out of the hedge book and left the debt. Which would have you done? Because the question on the call was, why didn't you clear out the debt? Because then you don't have, Macquarie doesn't have security on the assets. And Darren responded saying, look, that's because we've still got the mark-to-mark on the hedge book. Still, which is, what did you say it was?
After they paid back, they'll still have 350 million at 5,200 gold price.
Which means they've still got security on the asset. So look, because I told you me like the analogy for hedging that I've known for ages.
Tell me.
I've known this for ages. I can't believe I haven't mentioned it yet. 100% have not talked to. So like,
enlighten us.
These forward contracts are the dead set equivalent of short selling, effectively. So Macquarie are short selling gold and to Bellevue for these contracts. So all that hedge book that's in place, Macquarie have borrowed it from a central bank or bloody friggin' Fort Knox or somewhere, borrowed it, sold it into the spot market, got a heap of cash for it, put that on deposit, which is earning interest, and then those contracts are what Bellevue the gold that has to be given back to Macquarie so they can give it back to the bank. So when they say, like, they're obviously not making money on the gold price, but it's like that is why they've got security on the asset, because if, very obviously, like if Bellevue stops producing, Macquarie have to go into the market and buy all that gold themselves.
That's on the asset side of their ledger. On the liability side is their obligation to return the gold at those predefined points in time, which they require Bellevue to deliver in order to meet those obligations.
And hence the decision because clearing the debt is like, whatever, you've cleared the debt. The debt isn't going to grow that much. But as you said before, that hedge book liability, if the gold price keeps going up, could keep growing. Hence, keeping the debt, removing the hedge liability for this year, for the remainder of this year, means they've got more of a runway to get free cash, keep the operation sustainable, deliver the gold into the hedge book, less risk of the worst thing happening of going into VA or like going into receivership or something where Macquarie have to go into the market, use the security of the asset to buy all that gold back to give it to the central bank. So that's why they've done it.
Yeah. And I think we talk about hedges, right, heaps, but the gold price going up is still good for Bellevue. It's still much more if they can obviously deliver the ounces.
So it's great if they can, deliver the ounces.
But it obviously increases the risk to Macquarie if they don't deliver the ounces.
Exactly.
For sure. No, I like that, Matty.
Yeah, no worries. I'm here all week, boys. Bloody, just a wealth of knowledge.
Yeah.
I've been bloody using everyone else's ideas for the last 2 years. I'm not going to stop now.
Quickest way to learn, mate. To frame your question as well, but go roughly a year back, or I guess 9 months or so back, to when they did the last raise and they cleared out debt. They would have had to be paying, on average, $15 million a quarter. They paid out $100 million of the $200 million in debt, so that kind of would have stung them a bit at the time, because they had the same decision last year and they went the debt route.
Well, I suppose it's been a perfect storm, hasn't it? So not an unperfect storm, from when they took that debt to, okay, we're going to go down the debt route. We're going to have the least amount of dilution. We're going to get a great earnings per share. We're going to have this great rated company on an EBITDA multiple. Gold was, those $2,800 hedges, they were above the gold price at that time. So everyone just forgets. It's like, oh shit, why'd you hedge at that price? That's what the bloody gold price was. It was bloody lower, and it was in a lower interest rate environment, which mean obviously the hedges were at not as much of a markup to the spot price because they hold the money on account. Higher interest rates means they could give higher forward contract prices. But now gold price has gone up shitloads and interest rates have gone up shitloads, which means it's more impactful on the debt as well. So it's just really snowballed into what we see today, unfortunately for them.
Yeah, it's fascinating to think that the hedge liability that will even be remaining after this is multiples of what the initial project finance facility was. It's remarkable how all that kind of works. Yeah.
Oh, and that's the unfortunate thing, because this could have been, as we're talking about it getting sold at $1.10, $1.30 or whatever. It's just it's unfortunate to see if they did execute, did pay off the debt without raising, delivered into that hedge book over a longer term. This could have been a freaking huge, this could have been a $3-4 stock with that management, a management premium and delivery and everything. It just unfortunately didn't happen. So it can really go either way. I'm sure the shareholders were wishing that too.
For sure. We'll see what the future holds for the new shareholders. It'll be interesting with those sort of carrots they've dangled.
So do you reckon this is the final reset? This is the biggest reset? Well, no.
I hope so.
No, sorry, I don't think it is, because this is the reset that should have happened when they raised last year instead of releasing that 250,000 ounce plan. This should have happened at Diggers, before Diggers, when they said, we're just revising, it's going to be 190,000 ounce mine. It's not a 200,000 ounce mine. It's 150 next year. This is what should have happened then. So, it's a bigger reset compared to what they said they were going to do, which was much higher. But is it the final one?
Yeah.
Still 47,500 ounces a year, a quarter from FY27 onwards?
It's tricky to have confidence and say yes, because you do want to believe the revisions every time, but then there seems to be just misses that weren't foreseen and things like that. So you want to think the operational kind of question marks are in the background now. You really do want to believe that. I think because they've alleviated the short term looks reasonable. I do worry a little bit about that 2027 period when you've got more hedging and the debt repayments kind of kick in. I think it all depends. I think it depends if Bellevue kind of keep persisting on their own, or if they get taken over. If they get taken over, it's the last reset. If they persist on their own, there might be some more kind of things to face as the cash flow looks compressed in that year.
And if they get taken over, no one's looking at it as much.
Exactly.
It's mixed in with 7 other fucking assets. It's Bellevue, it's all good. It's ticking along. But I like how it's 150 next year. That indicates to me, right, they're probably going to, I know they're dropping a jumbo off and everything, but it's hopefully they get a bit ahead. Sounds like a lot of the critical infrastructure is probably in. It's going to come down to obviously they've alluded to the mining practices. Once they tidy that up, then it's up to the ore body. It's going to be up to how that ore body behaves. If there's many irregularities, as long as you stay on the ore, top level and bottom level, what happens in the middle is out of your control. So as long as all that is done spot on and slowed down, which sounds like they're gonna, it's up to the gold gods then. Sounds like they got the processing plant, sort of the upgrades and everything, like the oxygen circuit that they talked about. They talked about the increased sulfides and the need for the oxygen circuit to alleviate the higher use of cyanide, which is copper. They don't say copper, they say sulfides, but it is because of copper in the sulfides that cause. So that's what the oxygen circuit's trying to. So it sounds like it's manageable. The recoveries are going to be hopefully maintained at a lot higher. And then their recovery issues before, a lot of it was because of this fucking rush, trying to get the quarterly numbers out, throwing a shitload of, in cases, throwing a shitload of high grade in at once, and then you're pissing a lot out to the tailings because you're trying to get the gold quickly. So, I reckon, I don't know, I'm saying 180,000 sustainably. Instead of
Seems
190.
like a good spot to leave it.
Nothing like that. Yeah.
I think we'll see how they go against that.
Who do you reckon is going to come with it? Themselves or which other? Come on, you've got to start throwing some darts as well, boys.
Who's going to be the final buyer?
Who's going to be running Bellevue in FY27?
Northern Star.
That's a good one.
Is it cheating if I say the same? Do I have to go different? Northern Star seems the most logical. I'd chuck in Goldfields just to spice it up, but I think that's a lower probability.
My roughie would be Regis.
Keen.
I'm gonna throw. That's the hardest thing though. Like the reason I'm going against Volt is the whole succession plan of that business probably relying on maybe Genesis, which take over from Luke Tonkin, unless Luke has a swing at this and then maybe makes himself more amenable to Genesis, or he might just go forever. I think Volt's the dark horse on this. And it'd make a lot of sense for that to go down to their mill. It'd need some upgrades and everything. I don't know if it's got an oxygen circuit or, Volt. But I reckon Northern Star.
Alrighty, let's thank our awesome partners, I reckon.
Jeez,
get your tickets.
Remelius hasn't even got a mention.
Yeah, they got a great project now.
They got their hands full.
God, that could be a real dark horse. Righto, let's take the partners. What, mate? Bloody, the Underground Operators is finished. GRX conference is coming up. Brisbane, May 20 to 22nd. Oh, God, I should be recovered by then. Can't wait. The Centre of Tech and Innovation. Discount code on LinkedIn, in the show notes. Make sure you grab on it. Our other partners, I haven't said these guys for a week. I've been Devo. Mineral Mining Services, Grounded, Sandvik Ground Support, CR Insurance, K-Drill, WA Waterbores, Quattro, KCA, Black Diamond Drilling Services, Cross Boundary Energy. Hooroo, boys.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.